Inflation's latest twist. A delayed report reveals rising prices amid political turmoil and trade battles. Here's why it matters more than ever. Get ready to dive into the latest buzz on U.S. inflation, which ticked up just a bit in September as the Federal Reserve gears up to slash interest rates once again next week to keep the job market afloat. We're talking about the Consumer Price Index, CPI, that key economic indicator, which finally dropped from the Bureau of Labor Statistics on Friday after a 10-day delay. It showed a 3% jump from last year's September, the quickest yearly climb so far this year, edging up from the prior 2.9%. And don't forget core inflation, the Fed's favorite measure that ignores volatile stuff like energy and food costs. It dipped slightly but still hit 3%. On the monthly front, overall consumer prices rose by 0.3%, matching the hikes in both core goods and services. But here's where it gets controversial. This report's delay wasn't just a minor hiccup. It stemmed from the ongoing government shutdown, now stretching into its fourth week. Without funding, the Bureau of Labor Statistics had to halt everything, including the monthly jobs report and future data gathering. There was one exception, though. September's inflation data got a special release because of a looming November 1 deadline for the Social Security Administration to adjust benefits based on living cost changes. Picture this. Without this data, retirees might see their checks unchanged, which could cause real hardship for many on fixed incomes. The timing couldn't be more critical. This report landed right before the Fed's two-day policy meeting starting October 28th. Experts widely predict another quarter-point cut in borrowing costs, dropping rates to between 3.75 and 4%. But, and this is the part most people miss, the Fed's job is about to get insanely tricky. They must balance slashing rates to support employment with keeping inflation in check, all while much of the economic data they rely on is stalled due to the shutdown. This shift toward looser monetary policy, it's fueled by worries about the labor market. Fed Chair Jerome H. Powell recently admitted it's no longer very solid after job growth slowed sharply, even as unemployment remains steady. Companies are holding back on hiring due to economic uncertainty and fewer available workers thanks to new immigration curbs under President Trump. Yet inflation isn't the Fed's only headache. Prices have been stubbornly above the 2% target for 5 years, and recent months have seen spikes from Trump's tariffs. Broad duties on nearly all trade partners, plus specific ones on cars, lumber, and more. The average tariff rate? A whopping 18%, the highest since the 1930s. Think about it. This could be rekindling memories of the Smoot-Hawley Tariff Act, which many historians argue worsened the Great Depression. Is history repeating itself, or is this a smart way to protect U.S. jobs? Food prices are up, hitting consumers hard with higher costs for coffee, beef, and more. Furniture and clothing aren't spared either. But car prices? They've seen more modest rises. As a counterpoint, energy prices have actually dipped recently, providing some relief. Companies stockpiled goods before tariffs kicked in, giving them a buffer, and many hesitate to pass on full costs, fearing it'll kill demand. For beginners, imagine tariffs as a tax on imports that raises prices, but companies often absorb part of it to avoid losing customers, at least initially. Fed Chair Powell has argued tariffs cause a one-time price bump that fades over time. Economist Veronica Clark from Citigroup agrees that it might take a year or more for prices to adjust, especially since consumer strength seems weak. Demand for workers is really low and wages are going to keep slowing, she notes, highlighting how tariffs could squeeze household budgets even tighter. But not everyone at the Fed is ready to downplay inflation risks. September meeting minutes show some policymakers hesitated on rate cuts due to stalled progress toward that 2% goal. Services inflation, covering haircuts, travel, and auto repairs, remains sticky, even as housing costs ease. If this sticks or worsens, inflation could linger above target, especially with more cuts planned, another quarter point in December. And the longer the shutdown drags on, the blurrier the economic picture gets. October's data, not being collected, potentially delaying November reports. We'll start to miss that data, Powell warned, calling it more challenging. For example, without fresh inflation numbers, the Fed might misjudge the economy, leading to policies that either overstimulate or understimulate growth. On a brighter note, the report wasn't all doom and gloom. Egg prices fell 4.7% month over month, down from flat in August, thanks to easing bird flu impacts on poultry. Core prices rose less than expected, and overall inflation was milder than forecasted. Food prices nudged up 0.2% for the month, slower than the 0.5% in August, but 3.1% year over year. This benign outlook comes amid the Fed's willingness to cut rates even as inflation rises, as Powell emphasized in August, to prop up jobs. Procter & Gamble, the giant behind household brands, just shared quarterly earnings with 3% sales growth in a challenging consumer and geopolitical environment. Tariffs will cost them $400 million this year, yet they've only raised average prices by 1% so far, showing companies' reluctance to fully pass on costs. Stock markets? Futures edged higher pre-report, with SP 500 and Nasdaq climbing, though against a backdrop of choppy trading after a big rally. This might be the last economic data for a while. The Bureau recalled workers just for this report to calculate Social Security adjustments, but they're back on furlough now. No data for October's inflation or the November jobs report, and agencies like Census and BEA are shut down too. Interestingly, data on resilient spending often masks deeper divides, mostly from the wealthy. Wage changes year over year show the rich powering ahead. The top 10% of households now drive nearly half of all spending, per Moody's Analytics, a record since the 1980s. While high earners' sentiment is up, others is falling amid inflation and job market woes. This isn't just an inequality story, it's a macroeconomic story, says Lindsay Owens of the Groundwork Collaborative. As the wealthy continue to consume, that's masking more and more insecurity and instability in the economy under the hood. For instance, premium airline seats are selling out but economy fares struggle, and credit card perks lure the affluent while lower-income folks juggle debt payments. Even McDonald's CEO Christopher J. Kempczynski noted double-digit drops in visits from low-income consumers, urging caution on the consumer outlook. On tariffs, the Treasury collects $30 billion monthly in customs duties, but who pays? Companies initially absorbed much, but earnings calls suggest that's changing. Goldman Sachs estimates 37% passed to consumers by August, 9% to suppliers, and 51% absorbed. But this is milder than during Trump's first term, thanks to healthier margins, consumer fatigue, and hopes tariffs might ease. Consultant Michael McAdoo shares how clients first swallowed costs, then squeezed suppliers or raised prices. Companies like Nike, $1.5 billion hit, Mattel, $100 million, Raytheon, $220 million, and 3M, $100 million are feeling it, with Halliburton eyeing $60 million more. Some offset fully. Autoliv recovered 75% and expects 100% by year-end. But customers like General Motors, $3.5 to $4.5 billion cost, raised prices less than 1%, pinching margins from 9 to 6.2%. Automakers hope tariffs are temporary and face domestic competition, keeping new car prices down since 2023 peaks. Automakers have generally held steady on price hikes because they're holding out for tariff relief, says BNP Paribas economist Andrew Schneider. Meanwhile, steelmakers like Cleveland-Cliffs boom from higher domestic demand. Harvard Pricing Lab data shows domestic prices rising slower than imports, boosting U.S. makers. PACCAR, a truck maker, took a $75 million hit, but expects gains from a new 25% truck tariff on November 1st. Even holdouts plan future hikes, especially in import-heavy sectors. Furniture prices are surging from China tariffs, and Flex Steel warns of broad price increases that could hurt demand and margins. Banks like Fifth Third see each party, Suppliers, intermediaries, customers, absorbing a third, but intend to recover margins eventually. Gradual pass-through could prolong inflation. Big firms leverage suppliers for concessions, per Bank of America economist Stephen Junot, while small businesses struggle. Tea importer Richard Rosenfeld delayed hikes, but now faces big increases, with more coming as tariffs ripple through supply chains. So, what do you think? Are Trump's tariffs a bold economic strategy or a risky gamble that could fan inflation flames? Will the Fed's rate cuts save jobs without sparking a price spiral? Does the wealthy spending divide signal deeper troubles? Share your thoughts. Agree or disagree in the comments below.